Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about death and taxes. So a lot of you have asked me either through an email or calls that we've had, is there an inheritance tax? So we're going to go through that. We're also going to talk about death, taxes, and some strategies to eliminate or at least massively reduce the amount of tax that's going to be paid on death and some strategies around that. Before we jump into the content, if you're not already subscribed to the channel, please hit the subscribe button below. It takes 1 second, it costs you nothing. Still about 75-80% of you watching our videos are not subscribed to the channel. So join the community. We release 2 new videos every single week through summer. Once we hit September, we'll start doing 3 videos every week as well. Get back on track, just catching up from vacation at this point. So as Benjamin Franklin once said, there's 2 guarantees in life, death and taxes, okay? We can't avoid death, but we can actually avoid taxes, especially when we talk about taxes at death. So what are some strategies around that? Well, we've done some videos on this, but when we talk about reducing the amount of tax you're going to pay at death, first off, let's start with if you have registered accounts at death and you have a spouse or common law partner, those will roll to them on a tax-free basis. So if you have an RSP when you pass away, whether it's worth $1 or $1 million, that will roll to your spouse or common law partner tax-free. There'll be no tax due at that time. But when they pass away, if there's still a balance in that account, it'll be taxed in the year of death for them. So keep that in mind. So if you have a spouse or common law partner, there's some tax benefits there. I know we've talked about that lots. We did a video recently on, being a single person and how to, how you have to plan differently a little bit when it comes to registered accounts as a single person. But if you do have a spouse or common law partner, there's that ability to roll that over tax-free. So whether you're single or you're looking, further advanced of, okay, sure, my account will go to my spouse or common law partner tax-free, but when they die, it might be a day later, there's a big tax bill or a potential big tax bill due. So how do we plan for that? So, we've created different strategies for different clients depending on the situation, but we do find that what we call an RSP meltdown is the greatest strategy to reduce taxes on death. So again, when we pass money to someone, whether it's family member, friend, a charity, whatever it is, when we pass money as an inheritance, that is passed on a tax-free basis. So if you can pass that while you're living, that's the greatest thing possible, okay? And we talk to people every single day. We create financial plans. If we can free up some money, if part of their estate plan is to pass money, say, to kids or grandkids, if we can do that while they're living in a tax-efficient manner, it's a great way to do it because we can see, they can watch their kids or grandkids enjoy that money. It changes their world. That's a great way to do it. So if you can start giving away money while you're alive, remember, you can gift that money tax-free. A lot of you think there's going to be taxes due. Yes, in the US, there's some inheritance tax and stuff if you hit a certain point. But in Canada, you can pass that money as an inheritance tax-free. So take advantage of that. So outside of an inheritance, obviously the CRA, when you pass away, is going to tax you on all your assets. So let's say you're either single or your spouse has already passed away, okay? So when you pass away, you may have a large tax bill coming. If you have any registered accounts, whether it's an RSP, a RIF, an old defined contribution pension plan that's rolled into a LIRA, anything that's registered, on day of death and year of death, it's basically liquidated, okay? So it's added to your income in year of death. Well, you can imagine if you have, registered accounts, $200,000, $300,000, $400,000, $500,000, you're gonna lose 40 to 50% of that to taxes, okay? It's a massive, massive amount. So it's really important to plan ahead. When you create your financial plan, you wanna plan longer than you think you're gonna live. Because if you live that long, you wanna make sure that you have some money there. But you also wanna look at kind of trigger points of life expectancy. So whether it's 82, 85, 86, 87, usually for most of you entering into your 60s, 70s, 80s, life expectancy is between that 85 and 87 number, okay? So you need to see, what is my estate tax when my life expectancy actually does hit? So if I live longer, I need to make sure I have money, but how do I make my estate tax as close to zero as possible at life expectancy at 86? So you need to create a plan around that. So if you don't have a clear tax plan around what the tax bill looks like when you pass away, you need to create one. Either create one yourself, work with your financial planner, hire a financial planner, whatever you need to do to get that number, spend some time and money to figure that out, okay? So again, some strategies would be RSP meltdown, which is all that is, as soon as you retire, start drawing down your RSP on a very aggressive manner and delay your CPP. What you're doing then is you're taking your RSP, which is taxable at death, and really drawing it down, trying to get it to zero by the time you're 86, let's say, okay? You're delaying the start of CPP till 70. What that does is allow CPP to grow. So when you turn it on at 70, it's increased by 42% more than what you would have collected at 65, okay? Now that's guaranteed for life, okay? So yes, your RSP may, wind down and may go to zero at 86, but you've also calculated in a higher CPP payment along with OAS and maybe some TFSA money and other accounts coming in, okay? So when you actually map that out, when we put together financial plans for people and we map that out, doing a strategy like that can be a big difference. So obviously you need to create a plan so you know how much to pull out of your RSP, how much you can take out to make sure you don't run out. But focus on that number around 84, say to 87, how much estate tax you're going to pay to make sure that you're not, when you pass away, you're not leaving a whole bunch to the government, that you've actually planned ahead, you've been able to maybe gift it ahead through inheritance, or even gifting it at death through inheritance with very little taxes due. I was speaking to someone the other day. They contacted me through YouTube, watching some of these videos, and he said, I've just entered retirement, and my accountant was applauding me because last year I didn't have to pay any taxes. I pulled money from TFSA and other sources, and I didn't have to pay any taxes. But after watching some of our videos, he said, the light bulb went off that if I didn't pay any tax last year, all that means is I'm deferring it down the road. And that's not always the best strategy. So again, paying no tax is great. But the reality is if you have registered accounts, which most of you have watching these videos, there's going to be a tax bill due, okay? Hopefully, when you put money into your RSP, you're in a 30 to 40, maybe up to 50% tax bracket. So you're getting a great, tax refund every year on your RSP deposits. When you enter into retirement, you now want to try and level off that tax bill through retirement, okay? So I would say 90-95% of the plans that we put together for clients, we're averaging, an average tax rate in retirement between about 8% and 15%. Okay, that's what we're looking to do. So if we can average a tax rate of 15% in retirement, but you got a 40% tax rate putting money into an RSP, your money's growing tax deferred, that's a nice spread along the way, okay? So yes, there's still taxes due in retirement, but if we can level that off and really try to, eliminate an estate tax by the time life expectancy hits, that's a great plan to pay as little tax as you can to the government, create a nice level income stream, and when you pass away, make sure that as much as possible goes to your loved ones, to a charity, whatever it is, versus the CRA. One last thing I want to touch on when we're talking about inheritance and taxes on death and that kind of stuff is probate fees. I'm not going to cover off probate fees in detail in this video, but it is something to consider. Most provinces and territories have a probate fee, okay? They vary per province and territory, so wherever you live, check out what that is. But as you get later on in life, you may be planning to pass money to kids, grandkids, charity, whatever it is. Be aware that even your principal residence, when you pass away, yes, it is tax-free, but it's part of your estate and there's probate to be paid on that, okay? So be aware of that. So if you plan to pass the value of your home when you pass away, maybe there's a way to sell your home a little bit earlier and pass the cash to, say, your kids or grandkids as an inheritance. So what that does, if you can get that out of your estate or out of your hands before you pass away, it won't be part of your estate and it will lower the amount of probate you have to pay. So in BC, anything over $25,000, the probate fee is 1.4%. So on, say, $1 million home, that's $14,000 of savings. Now you might own a $2 or $3 or $4 million home. So the savings can be massive with probate. So as much as you can get out of your hands into kids, grandkids, wherever you're shuffling money off to, if you have that estate plan. If you're someone, and a lot of you we talk to, you don't have kids or grandkids and you want to spend every single dollar before you die, again, that's another strategy. You need to, plan till 95, we always say, to make sure that if you do live longer than expected, you don't run out of money. You have a plan. But you also want to make sure that you create a tax strategy so that, by the time you hit life expectancy of, say, 85, 86, 87, most of your income is maybe coming through government sources. So when you pass away, you've already spent your personal money, or there might be a little bit left, but it can be maybe passed to a charity or something on a very tax efficient basis. Again, it could be taxed or passed as a donation, which is always very tax preferred. But there's some strategy there that needs to be looked at, whether you're looking to pass money through an estate or try and spend it all through retirement. So hopefully that helps give you some clarity around inheritance tax. There is none in Canada. Again, if you have, a kid or someone that you're passing money into that's in the States or has dual citizenship, there could be a bit of a tax issue there. So you want to check into that, talk to a tax professional that knows, how that works as far as US tax persons. But in general, someone in Canada, there's no inheritance tax. And again, two things are guaranteed in life, death and taxes. But there is a way to massively reduce the amount of taxes that we pay, both through retirement and at death. So make sure you have a proper plan in place. We'll put a link below to our fee-for-service financial planning that we offer. Again, we don't do these videos to push our services, but we also get a lot of feedback from our viewers that we don't know where to turn to. We need a plan, we need help. Who do we contact? Well, you can contact us. We do fee-for-service financial planning. We help Canadians right across Canada and abroad as well. So we've helped put plans together for people in Germany and Norway and elsewhere that are looking to come back to Canada eventually that are Canadian citizens. So, check out our link below. It's parallelwealth.com/FFS, fee-for-service. There's more information on there. You can book a call with us and move forward with a proper plan. And we put a very in-depth plan looking at all these factors that we talked about in the video today. So thanks for joining us. We'll see you in the next video.